So, bro, what's up?
Well, Allison, likely these days you've probably seen all kinds of stories about how we've reached the 10-year anniversary of the start of the current bull market, which means basically the end of the market dive that happened during the Great Recession. Market bottomed at the beginning of March of 2009, reached 10 years. It's been a fabulous time to be a stock investor. The S&P 500 has averaged around 17% a year. Fantastic. Unfortunately, it's not been a great time.
Here comes the awfulizer. Here he is.
No, it's not. This isn't awful. I'm just saying, unfortunately, over the last decade, it hasn't been such a great time to be a cash investor, right? Because they drastically lowered interest rates to as a remedy to the Great Recession. So back in March of 2009, looking at the 1-month Treasury, which is kind of a proxy for cash, it was paying 0.1%. Now, since then, starting in 2015, the Fed started raising interest rates. There were 4 hikes last year. So as of now, you can get 2.5% on a 1-month Treasury. So I bring this up for 2 reasons. Number one, the Fed is likely to pause at this point. As of even toward the end of last year, the Fed was suggesting that there were going to be 2 hikes this year. A lot of that has changed. A couple weeks ago, Chairman Jerome Powell, chairman of the Fed, told Congress that at this point they're going to take a watch and wait and see approach to rates, partially because of what happened in the stock market toward the end of the year, but also because growth around the globe is slowing, particularly in Europe and China, and inflation has been really low. So when you talk about inflation, most people think of the consumer price index. What the Fed pays attention to is something else. It's called the Personal Consumption Expenditures Index. They look at the core, which takes out food and energy. Most recent reading is 1.9%, down from about 2.5% as of somewhere in the middle of last year. So inflation is actually going down. So at this point, if you look at what the market is predicting about interest rates from the Fed, there's a greater chance that actually rates are going to get cut again this year than they're actually going to be raised. Most people expect that they're just going to stay the same. So what does that mean? That means right now you actually can get some decent rates from things like Treasuries, short-term Treasuries, 1-year CDs, 2-year CDs, 3-year CDs. People have been putting off locking their money up that way because they figure rates are going to keep going up. Now might be a time to consider grabbing some of those rates while they're still at this level. So, which brings me to my second point, and that is most people are not doing it. The vast majority of cash in this country is still sitting in checking accounts, savings accounts, sweep accounts, and I'll describe what those are in a second, that are paying 0.1, 0.2, 0.3%, where you could be earning much more. In fact, banks and brokerages are making millions off of people who are sitting there in low-yielding cash. And Jason Zweig at the Wall Street Journal has covered this a couple of times over the past year. So in August, Jason wrote this article where he pointed out that what banks have been doing, or brokerages have been doing, right? Let's say you sell a stock, right? And you have that cash in your account. Often they'll put that in a money market fund, which these days are yielding 2 to 2.5. What a lot of them have been doing is taking the money out of those funds and putting it in a sweep account, which is more like a bank account. But they don't often hold it. Instead, they farm it out to another bank. The bank pays the brokerage 1.5%, 2%, but you're only getting that 0.1 or 0.2 or 0.3%. They're pocketing the difference. This is how some of these online brokerages or app-based brokerages that offer free trades, this is part of how they make money.
Right. It's
because that cash sits in your account earning nothing, but they're able to earn a little bit of money on it. So bottom line here is don't let them do it. There are many ways to earn 2.5% on your cash. A couple places to look. Of course, the Ascent, which is a Motley Fool company where you can get various ideas for where you can get good yields on savings accounts, checking accounts, money market accounts, also reviews on credit cards and mortgages. A couple other places to look is just your local credit union. There are actually many credit unions that will pay you up to 5% on your checking, up to a certain amount.
Wow.
Like up to your first $2,000 or $2,500.
Yeah.
But so you want to look at what's in your area. And for your brokerage account, probably the best bet is a money market fund, which is different than a money market account. Money market account is offered by a bank, FDIC insured, very safe. Money market fund is a mutual fund of short-term treasuries and short-term debt. Still historically very safe, but not guaranteed. So you're taking a little bit more risk. But if you go to cranedata.com, every day they will list the top 5 yielding money market funds for taxable accounts, then top 5 tax-free, and top 5 for institutions. These days, the best rates are coming from Vanguard and Fidelity and those folks, and you can get 2.5%. Not a whole lot of money, but it's still better than nothing. And if you have a lot of cash sitting around in your emergency fund or whatever, why not make that extra $100, $200, $300?